So welcome everybody. Welcome back to our former investors. We're really excited to partner with you once again, and equally warm welcome to our new investors. Really excited to share this one with you. Before we kick off, just a couple of administrative things. One, this is being recorded so we can play it back, share it with our colleagues and friends in our investor base. So be noted of that this is recorded. Of course, just Aaron, myself, and Brian will be on video. Don't worry about that. Second administrative tip, there's a chat function in here. If you scroll to the bottom of your screen, let's use that for some live Q&A. I'll ask my partners here, Arne and Brian, to help field some of the questions during the session. So don't feel like you have to run before the end or you want to get your question down on paper. You can just pop it in the chat window. We'll tackle as many as we can. Prior to the end, we'll do a formal Q&A. I've got a bunch of pre-submitted stuff we'll run through there too. Other than that, we will go ahead and get rocking and rolling here. Excellent. So quick backdrop here. So Arne and I, if you recall, if you worked on the comments with us, Arne, Brian, and I are getting the band back together, if you will. After 14, 15 months, Arne, what's the exact time from when we closed Carolina Commons until now?
Well, May to June, so 14 months, basically. Yeah.
So we've been looking steady, and Arne tells me I'm too picky, but I maybe there's good reason for that. But we finally landed the right asset and the right market under the right terms, right conditioning, right financing, and just everything just is kind of falling into place. So we're really excited to share this portfolio with everyone today. It's really two different properties. We'll get into the details here in a second. Of course, starting with our normal disclaimer, we are not attorneys, we're not CPAs. Don't look to us for tax advice or legal advice. And second point here, really, this is open to is a 506c investment. It's open to accredited investors only. So any questions on that piece, you can throw them in the chat or you can email me directly, but I think we're pretty clear there. Quick rundown of what's to come. It all starts with the team. So we'll take a rundown of who's going to be who's running the asset, who's the lead sponsor. We'll look at some of their track record there, some of the things we look for in the team and who's doing what and roles and responsibilities. I'll also give you guys a chance to meet Arne and Brian here a little bit more formally, our boots on the ground and our trusted partners right in Greenville, living and breathing there. I'll run through an executive summary for those that are either pressed for time or have short attention spans like myself. We'll give you kind of the 80-20, 80% of what you need to know in the first few minutes in the summary, which will cover the asset, it'll cover the financing, it'll cover some of the business plan, and then there's a lot more detail to come, both in this deck in the presentation, and as what I send out will be more an extended read. If you want to dig into the numbers a bit further, that's there as well. And we'll cover both of the assets, what's in them, what we're planning to do, how we're planning to renovate them, how we're going to push rents, some of the big opportunities there, the big and the little stuff. We'll cover that in the highlights. We'll talk more about the property itself, its location, its positioning, cover a little bit of the finances, the different classes and tiers of investments we have available to you guys. And then Arne, Mr. Greenville himself, AKA the mayor of Greenville, will cover Greenville itself, the submarket. Arne lives and breathes the areas we'll cover in a minute. So I would never do it justice the way that Arne and Brian can step in there too, that they will. So I'd ask them to lean in there a bit, which is great. And we'll wrap up with some summary, just a kind of a summary of the financials, what's to come, next steps, and we'll do some back and forth live Q&A. All righty. Trying to get my slide to advance here. As I mentioned, it starts with a team. And anytime we're looking for an asset like this, you can have the best asset and the best terms, the best conditions. And without the right team and the right experience, it really doesn't mean anything. And there's the ease that it increases your risk tenfold. So when Redline looks for a deal, and Spark and Redline have worked together in the past successfully, really enjoy working together on an asset this size, we really look for that tremendous depth and experience. So Reed was actually in the background as a key principal on the Carolina Commons deal as well. And we look to their depth, and we'll get into some of their track record here in a second, but really look to their expertise, their opinions, their negotiation power, their economies of scale. All that stuff is really factored in. And when we talk about the different roles, they bring a lot to the table. This is actually only a fraction of RSN's working group. We hit the highlights here, the ones that are most relevant, but there's a whole depth of people that we can tap in for expertise there. And they've run, I think, Arne, keep me honest here, I think about 680 million assets under management in Reed's group. Is that a fair latest number?
That would be fair. 3,000 units, probably a little more. So yes.
Awesome. So then we've got Ben Gray, the COO, who handles a lot of the marketing and the acquisition side of things. And Josh, I know somebody asked a question, we'll cover it later, about who's going to be asset managing. Josh on Reed's team with a heavy involvement from Reed himself. And then we've got Aaron and Brian on the ground. So without further ado, for those who haven't met me, I know we've got some new faces on the call. My name is Andrew Shutsky. I'm based out of the Philadelphia area. I've been investing in real estate for about a decade and a half now. On the multifamily side for about 2.5, about 60 million assets under management, and invested in about 1,300 doors. I really just love doing this stuff. Those that know me know that I get obsessed and passionate about investing in real estate, host a podcast myself, and just love doing this. And really, really happy to introduce Arn and Brian. So again, I will never do them justice. I'll let Arn, the mayor of Greenville, talk to his intro real quick.
Well, thanks, Andrew, and great to be here, and excited to partner again. Yes, I love Greenville, but to back up, I was born and raised in Silicon Valley, and after grad school, had the good fortune to go to work for my father in his residential brokerage business located in Menlo Park in Palo Alto, California, way back in 1978. So I think if my math's correct, I've been in the real estate industry 44 years. 35 of which was in Silicon Valley. So I did residential brokerage, built a small single family rental portfolio. Well, I don't know if small is the right word. It was a nice single family rental portfolio during that time, both in the Bay Area and across the country. And then in 2014, my life partner, Laura, and I decided time for a change, time to make a life transition. And of all the places in the United States we could have moved, we chose Greenville, South Carolina, and I'll speak to that a little bit later. But we moved to South Carolina, Greenville, South Carolina, in November 2014. Continued buying single family rentals, did a lot of flips. Finally convinced my good friend and key associate, Brian, to join me in multifamily. And since then, we've done about 3 or 4 either syndication or joint venture deals in Greenville. And Brian does a great job. And without him, couldn't do what I do. So let me turn it over to Brian, and he can tell you a little bit about himself.
Great.
All right. Thanks, Arn. Well, my name is Brian Walsh. Like Arn, I live here in Greenville, South Carolina. I'm originally from Warwick, Rhode Island. Moved here 15 years ago. Married, have a couple little girls. So kind of as far as our professional background, about 13 years ago, I started Progressive Properties of Greenville. So our office is ironically about 5 minutes from these 2 assets, which is great, nice and convenient. Drive by them pretty much every day of my life. So what we do at Progressive Properties, we're primarily a residential property management company. We specialize in single family and small multifamily properties. We currently manage about 420 properties in total, doors in total. In addition to doing your traditional property management, we also have a 6-person in-house maintenance team where we facilitate and take care of all the turnover repairs. And we do a lot of renovations for our homeowners as well. So we've renovated probably 150 plus houses here in Greenville in the last 13 years easily. And I can't even imagine how many turns we've done, hundreds. So definitely kind of have the inside track on what needs to be done to get these units turned over and rented quickly. It's what we do all day, every day. We have great relationships with a lot of local vendors, any roofers, plumbing, HVAC, gutters, garage door, you name it. We have a relationship with local vendors. So we're definitely the local boots on the ground with the local connections that we've had for many years now. So, and then to kind of follow up with what Arn said a couple of years ago, Arn was actually a client of mine that I was managing some property for, and a friend of mine, I've known him for years, and he reached out to me about getting into some multifamily syndications with them. And after a little coaxing, we took the leap of faith, and wish I did it 10 years ago. Absolutely fell in love with the multifamily space. I was a little too comfortable in my single family world, but I definitely saw the light very quickly with what opportunities can arise from the economies of scale of multifamily, and definitely fallen in love with it. So here we are.
Awesome. Thanks, Brian. And I will say that despite being a New England Patriots fan, he's actually a really good guy.
Yeah.
we get, believe it or not, for those who don't know, I'm a big Philadelphia Eagles fan. We have some good fun teasing each other. And I think we're just bitter about being the underdogs all the time. So it's all good. All good. But thanks, Brian. We're so fortunate to have Brian and Aaron on the ground, and they're in your decades of experience, and they're literally right down the street. It's so rare you find an asset like this and being able to run over there in 5 minutes, and these guys their life is devoted to this stuff. So really fortunate to have them on the team.
And Andrew, just to jump in, I mean, we currently own a smaller multifamily on East North Street, about a mile from this property. So we really know the local market. We know what these units rent for. We've got our finger on the pulse of what's going on in Greenville. And then the one other thing I would add is our relationship with Reed Goosens extends several years. So we've been able to develop a good working relationship and a friendship. He was in town last week, and we probably spent 48 hours together. So the team, including you, has some history. We know we can work together. We work together well, cooperatively. So there's a prior connection there between all the people on the team. And I think that's important too, right? So
absolutely.
We've worked together in the past. We enjoy working with each other. We understand each other's roles and responsibilities, and we let each of us do what we do best. And so it's really an effective team. Reed is a nationally known syndicator. Brian and I know Greenville, and so the team is really, I think, solid.
Fully agree, man. You covered it. Yep. Awesome. So kind of wrapping up on the team side of things, again, there's many people you can partner with. In fact, Aaron and I are approached all the time with big name deals even from nationally known syndicators. And what I look for, is where the values align, right? Do they communicate well? Are they all over managing the asset? Do they have the track record? Do they align with the same, strategy and investing principles? Is their hold period aligned with what our investors want, right? Do they have the experience in the market? So all those things are factors, right? So we're really selective about who we work with, not only what properties we buy, but who we work with, what their values are. Do they align with our interests and our principles? And with 100% certainty, I can say RSN is that group. Again, the track record, when you're purchasing a $35 million asset, you absolutely want to have the best, the brightest, and the depth of experience. And not only just the track record, but if you look at RSN's last 6 exits in the last year, they're flawless, right? They've all met or exceeded expectations with the team. Again, once or twice could be a fluke, but with this type of track record, it speaks volumes to itself. Don't need to say much more about that. They're rock stars. So our property management team, arguably one of the most important roles in success in the asset. I'll let Aaron talk real quick to the relationship with Eastland and why we selected them.
Sure. So the leader of Eastland Management Company is a guy named Mike Holmes, who lives in Greenville. The office is in Greenville, and actually way back in the day, he actually lived at one of the properties at Bonita. So he has great market knowledge about Greenville. And by the way, over the last 12, 18 months, Reed, Brian, and I have been going after numerous Greenville assets. And on most of them, we've had Mike walk them with us, do the tours with them. And oftentimes he either knew who owned the property a couple years ago, or he managed it at one time. So Mike really is experienced, has a good team, knows Greenville. One of the people on the team is a syndicator named Jonathan Trumbley out of New York, who owned assets in Greenville from 2014 to 2019. And he used Mike as his property manager. And Jonathan swears by Mike in terms of executing the value add plan, increasing value, helping on the exit at a profitable return. So we're really happy to have Mike and his company Eastland on the team. Brian has a great relationship with Mike, and essentially Brian and Mike will be working together to get the nuts and bolts of the renovation and the value add plan and the business plan completed.
Yeah.
And so I have a lot of confidence in both of them.
Awesome. And for those who this is maybe your first time investing or prospective investment, arguably one of the most important roles of the team, because one, they're vetting the asset and the deal with you up front. They're validating our underwriting assumptions. Yes, this makes sense. Yes, we can achieve those rents. Yes, this makes sense in a whole. They're walking the property. They're your ears and eyes on the ground every single day. They're dealing with tenants every single day. It's not always you have an Arn or a Brian nearby. We have that advantage, but a lot of times you're really relying on the PM team. So critical to get that right. So happy, $1 billion in management, been around since the late 80s. They've been around the block once or twice, it's fair to say. So we're in good hands with Eastland. Thanks, Arn. So summary level, as promised, again, we're buying the assets about $35.5 million. It is 2 separate properties, Bonita and Calabria. We're expecting to hold to execute the business plan between 3 and 5 years, 281 total units, really strong occupancy going in the mid 90s. They're just about a little bit above submarket average, built in the mid to late 70s, as mentioned before, open to 506Cs. One thing I really like about this too, or more than one, but the really nice unit mix between the 2 properties. It's got studios, 1 bedrooms, 2 bedroom, 1.5 baths, 2 bedroom, 2 baths. A really nice mix of units that appeal to a variety of different tenants. We're buying them, as Arn will talk to later on, well below replacement costs. He'll talk to a couple of examples of newer construction when we get into the Greenville side of things. You'll see that we're going in at a great entrance point. One of the other great factors around the debt side, and we'll talk this a little more detail later, is we did secure and just signed a term sheet for fixed rate debt for the next 3 years. So that's really great. And total raise is just about $16 million, which covers the purchase price as well as our CapEx plan, which we'll talk to in a little more depth. I won't touch on all the great stuff about the submarket here, but I'll say a couple of highlights here. Greenville is absolutely exploding. When we talk about the term emerging market, and this being one of the hottest emerging markets in the US right now and ranking #1, which Arn will cover this in much more detail in a second. But if you compare this to your traditional Atlanta or Charlotte, 2 of the great things about this is 1, it's a lot more affordable. And 2, the growth has just been exponential. And there's a lot more room to grow in a market like a Greenville, South Carolina versus an Atlanta or a Charlotte or an Austin, Texas. They're great markets as well, but the upside potential is here. We'll talk about the job and the housing situation. We'll talk about the population growth, which has been exponential. We'll talk about the employment base. You'll see a lot of big names out there that Arn will go through. And we like about this a lot. There's just the ability to grow rents is astronomical. We've got about $150 to $300 conservative month projection premium out there. In fact, we're projecting, we're being conservative in the projections, but even without renovating, we do believe with Eastland's backing and confirmation that we could raise rents substantially without doing anything. So awesome cost basis going in and a lot of upside there. So what are we going to do? We'll cover the business plan in a bit more detail, and you'll see a line item of exactly what we'll be implementing at the properties. But this is a traditional value add, which is becoming increasingly more rare. I'll call it a diamond in the rough. 95% of the units have not been touched. So there's the ability to renovate the interiors. We're looking at which bring them up to a platinum level. We're looking at common area amenity proficiencies. Most of the deferred maintenance is already taken care of. So it's really just a lot of cosmetics, rebranding, repositioning, cleaning things up, updating the amenities to appeal that higher class tenant base. So a lot of upside there. On the operational side, the prior owners just left a lot on the table. There's a lot of economies of scale to be gained. These properties are just right across the street from each other, and they've got, I believe, separate leasing offices now. So things like that, sharing the maintenance staff and operating them as one rather than two individuals. There's a lot of economies of scale to be gained there. We always get the question, hey, how strongly do you guys believe in this deal? Is this a great deal? Are you guys personally investing in this? And I'll cover this in the FAQs again, but yes, the team's investing over $1 million of our own money in this deal. So clearly we're a big fan of it. We believe in the upside. Even in volatile times, we've secured the right debt. It just checks all the boxes for us. And finally, for those that might be looking for a tax write-off to offset passive income or anything like that, this is, if you're not familiar, and again, I'm not a CPA, but 2022 is the last year for 100% bonus depreciation. And there's a reference slide in here that breaks down what that looks like and how much we'll be expecting to write off in the first year. And this will be phased out for those unfamiliar in the next 4 years. So we plan to leverage that as well as your typical depreciation and expenses in the first year. So the business plan. So diving a little deeper, as we go into this property, how exactly are we going to add value to this units, and how do we go about doing that? Well, it starts from the inside out, really. As I mentioned before, 95% of the units have not been touched. So we're going to turn 218, I think is the official number, renovate all those to our platinum level, which if you look at from the kitchens out, it's granite countertops, it's the upgraded sinks, it's the cabinets removed and replaced, lighting, hardware, backsplashing, new flooring, which covers, pretty much the majority of the inside of the unit will be new. In addition, we look at other things that we've implemented in other properties and RSNs used in other properties, like the additional trash valet and washer and dryer hookups in our one bedrooms. And there's all those little things. They're small incremental pieces, but they add up to something substantial. Something that we'll talk to later too is that one of the properties has garage spaces, I think 34 or so. They're only getting $25 a month rent currently. So another, just again, all these small things, seemingly small, add substantial value as you increase the NOI, but by years 3, 4, and 5. We talked about the common area. As you see the breakdown of the properties, there's a lot of really great stuff from pet areas to barbecue areas. We're going to clean that up. We're going to enhance the curb appeal, rebrand them, refresh the clubhouses, just make it more of a community feel. And again, trying to attract that upper end of the tenant base, where you have those premium rents and you have the higher quality tenants who are there to stay, and sticky tenants, what we want. So we talked about Eastland already. I think we've covered that already. And finally, one other area we look to implement, and we do at all our properties, is where can we leverage the sustainability side of things and low flow toilets and water saving where we have common areas. Again, something we've implemented, and it adds up to something substantial, and it also helps the environment, which is really cool. We talked about the debt. Just getting into a little more detail here. We've secured, again, lowering the risk substantially down to a 95% loan to cost, so putting a pretty big chunk of money down. We're fixed rate locked in at 5% with no prepayment penalty. So it gives us a lot of flexibility to exit between year 3, 4, or 5. And we'll continuously assess the market, likely starting in a couple of years out. Once we've turned a lot of those units, it's typically when we'll start testing the water to see, what are the conditions out there? What do the interest rates look like? And then what the demand we know is strong in Greenville will continue to be strong. So we'll continue to assess that during the whole period. We'll talk about some of the assumptions in underwriting in a second, but one of the big highlights for me, if you look at any of the projections for Greenville, the rent growth has been astronomical, 12, 13, 14, 15%. We don't expect that to continue at that rate. But if you look at a CoStar or Yardi, they're projecting a lot higher than what we've underwritten. We've only underwritten 3% rent growth year on year over the next 5 years. And that is quite conservative. If you look at any of the CoStar or Yardi projections, like I mentioned, they're potentially double or even higher than that over the next couple of years. I won't cover too much of the demographics in the job site because I don't want to steal Aaron's thunder later on, but I will note one thing. If you look at a lot of other cities in comparison, again, like a Charlotte or Atlanta, yes, they've added a lot of jobs in the last couple of years, but does the city or the MSA have capacity to continue to add jobs at that same rate? And if you look at some of these numbers for Greenville, the answer is yes. So they've added almost 170,000 jobs in the last 12 months. They project to add another 120,000 in the next 12 months. And I will say, even in the face of uncertainty and the economy not knowing where it's going to go, if you look back to 2008, 2009, multifamily in Greenville, even without this boom happening, still only dropped to like a 90% rate. We're about 95 right now. So again, a lot of positive things are out there. I won't steal Aaron's thunder. We'll let him cover that in a minute, but just want to hit on the demographics, some of the highlights there. A couple of pictures to kind of show you a visual of the before and after. Again, a lot of these units haven't been touched since the 70s or 80s. So pretty drastic changes when you go to the platinum level with all the things itemized here. I'm just really looking forward to, one of my favorite things is before and after pictures and videos and sharing them with our investors. And it just gets people excited and really helps the tenants there and the community and the feel. And just, again, it attracts a really nice group of tenants when you do this stuff. It's the fun part. So let's break down the two units. The first one, Bonito, and these are right across the street from each other. This one's across 14 buildings. So it's quite a diverse footprint, built in the early 70s. One of the highlights for me again here is a lot of these 70s assets, you'll see flat roofs, which if those that know me, I'm not a huge fan of. We always deal with issues in those types of properties. Both of these properties have pitched roofs. Nothing problematic. I'm happy to say that the team did the due diligence, walked through with almost 20 contractors on site in the last week. I'm happy to say there's nothing that they found that we haven't already accounted for in our CapEx plan, which we'll cover in a minute. But again, Bonito's got a really nice mix of studios, 1 and 2 bedrooms, good sized units. And if you look at the rent comp section, I won't bore you with all the details, but if you want to look at the appendix, massive upside potential. Again, I think there's a lot more room to grow here than we projected, but wanted to be conservative and be sure that we could hit those projections. As I mentioned before, lots of amenities, grills, laundry, mail center, clubhouse, all of which we'll kind of brush up and renovate. It's part of our CapEx plan. Second asset, smaller footprint, 2 buildings, but 100 units. So lots of scale here as well. Similar type of amenities here, a nice breakdown of 1 and 2 bedroom units. And if you'll notice on the bottom of the screen, the 2x2s, we've already have some units that have been turned, have been renovated up to that higher level. And you can see they're already achieving $1,350 a month. So the other ones are quite a ways off from that. We've got a lot of room to grow, and that's already kind of proving out informally our business plan, which we're executing. So again, a lot more reference in here in the backup slide if you want to dig in further to see where the comps are located, what amenities they have, all that stuff's in the appendix. A little bit on the financial side. So what to expect as an investor. First, we'll cover some of our assumptions in the underwriting. Again, lots of conservatism here, and we'll share some of those. A couple of key terms for that, those who haven't invested in this type of property before or real estate in general. One of the things we look at and we track really closely is occupancy, right? Like, so real estate and commercial real estate specifically and multifamily, it's a really simple business. You need tenants that have jobs or have a source of income and pay rent. There's not a lot of variables here. So we look for things like, as we renovate units, like how do we keep the property stabilized? So if you look at our projections on our underwriting, we're taking very gradual steps to turn the units. We're not wiping the building out. We're doing turning units as they become available and keeping a close eye on occupancy and collections. Rent growth, I already mentioned this before, but again, really big fan of taking the conservative rent growth approach with a 3% organic year over year. And of course, renovating those 95% of the units to bring us up to market standards. Expense assumptions, as you look through the details there, again, we are at or higher than the recommended assumptions for the submarket and for what you see in other syndicators and what they use. One example is we're still projecting the turnover costs to continue as they were in the last 12 months, but we've also accounted for renovating 95% of the units to be brand new. So clearly we won't use all those funding. That's just one example of many that I'm a big fan of how we underwrote this. And the interest rate, again, I talked on this twice already, but locked in at a fixed rate. So no risk given the volatility of the market. It's probably the one thing on all of our minds, regardless of your experience level. One thing you don't have to worry about. We might have the ability to do a refinance later in the property, but we will never do that and never assume that the underwriting as a guarantee, because there is no guarantee. We don't have a crystal ball, but that is for sure going to be an option. We'll continue to assess that as part of our exit strategy. Another big one, another big lever that you'll see as underwriters go through these things is the exit rate, the cap rate. So our going in position is at 4%, which is very conservative for the market conditions right now. And we're a full 100 basis points over that. So again, you'll see on typical average 50 basis points, we've doubled that So really conservative there. Just some highlights of the CapEx budget. So you can see an itemized list of what we plan to do, interior, exterior, and here's a breakdown of all the fees and exactly where your money will be going as an investor as you invest alongside us. So this covers about 5.3 million in total, which breaks down to, I believe, Arn, keep me honest, about 19,000 a unit. If my math's correct. So
That's correct. 19,161.
awesome. Awesome. So again, lots of detail here. So if you've got questions, happy to field them, but I won't take you through, in the interest of your sanity, I won't take you through line by line here. So the exciting stuff. So another big thing I like here, the way we structured this, is we've got a few different options for our investors, and it really depends on your investment goals, where you're at in your career, your life position, et cetera. We've got 3 different asset classes available. The first we'll call Class A. And this is really for an investor looking for that steady, predictable cash flow. The terms here, we've got a total preferred return at 11, and it breaks down to a 7% pref or a preferred return, which would start almost immediately and would be paid quarterly throughout the whole period. And I'll show you a quick visual on this in a second. And then 4% once we sell the asset. And the conditions for that, we're limiting that to only 30% of the equity. And that's a minimum investment of 75,000 per investor. And Arn, keep me honest here again, I think we've consumed about 3 to 3.5 million of that already. So there's still some room there from what I remember from Thursday night, if you keep me honest.
Yeah, still a little room. But yes, people like that kind of high preferred return.
Yep. Perfect. Class B, moving on, we expect most of our investors will come into this, and a lot of us will be investing in Class B. This sits right behind Class A in the capital stack. Again, you can see the graphic of that on the right. Terms here are a 7% preferred return, sits right behind Class A, 50,000 minimum, and it's a 70-30 profit split, 70% to the limited passive investors and 30% to the partnership team. For those looking to invest, a larger amount of equity, maybe you have a 1031 exchange, you want to roll into the deal, and you want the best terms possible. That one's got a 500,000 minimum, but it bumps you up to an 8% pref and an 80-20 profit split. So slightly better returns there if you're looking to move a bigger chunk of equity. Quick visual to see how the 3 classes compare, along with what does the returns of the project look like with and without debt. We call that unlevered and levered for those who haven't heard the terms before. And here you can see a comparison of the cash on cash, the ROI, the IRR, and your annualized returns across the 3 asset classes. Again, just different options for the group, depending on where you're at in your investing journey. And if you've got any questions or you want some guidance, again, we're not financial advisors, but happy to give our insight. But we do expect the majority of the equity to come in the Class B side. So quick examples of what this may look like. One of the main FAQs or frequently asked questions we get is, if I invest, $50,000 or $100,000, what can I expect to get over the life of the deal? Here's how it breaks down with a Class A. With 100,000, I put 100,000 in. I expect to get over the whole period about 157. And you can look at how I expect to get my cash flow from year to year. This is very consistent, but limited amount of upside on the deal going on the exit. Compare that to a Class B, more upside, but a slower ramp we expect a slower ramp on the cash flow and distributions. This starting a little later, and then we're catching up on the back end, but a larger percent return for those that are okay with, hey, I don't need that 7% right away in year 1. I'm okay. I want to maximize my return in that, let's say $50,000 to $100,000 or $500,000 investment equity chunk. And then Class C, again, for those that are moving larger amounts of capital, we can offer better terms with the 80-20 split. And you can see what that looks like with a $500,000 investment. So again, nice to have the options, but we do anticipate just working with different investors in different classes. So now I will turn it over to my man, the mayor of Greenville, Mr. Arn Senadella. Talk about Greenville.
Okay, sure. So let's see what the first slide says. Yeah, so happy to be here, and I do love Greenville, and people tease me about it. And Laura and I could have moved probably anywhere in the US that we wanted, other than maybe the Hamptons or Martha's Vineyard, and we chose Greenville because it offers a great quality of life. The downtown is fabulous. There's a river running through it, ending in a waterfall. We're a foodie town, rated the #1 under the radar Southern food destination. There are parks, festivals, free music downtown 2 or 3 times a week. Swamp Rabbit Trail, we're in the foothills of the Blue Ridge Mountains. So there are a lot of outdoor activities. And so there's a lot to do. And what we're seeing is a lot of people are moving to Greenville from major metropolitan areas in the Northeast, primarily New York and Boston, though we are starting to get some from Chicago. And of course, they bring money, they bring employment in the service and hospitality industries. And then Greenville, of course, is anchored by BMW and Michelin. So there are a lot of manufacturing jobs, kind of high-tech manufacturing jobs, the kind of jobs we need in the United States of America that pay a good wage and compensate people for their hard work. So it's a great economic mix. The other thing I would add is we're on the I-85 corridor between Charlotte and Atlanta. And of course, logistics and transportation is huge. So we kind of have a mix of a diverse economic base, varied industries, many of whom need to rent. And so it's a great market. There's good employment. It's affordable. And the downtown is really kind of fabulous. So that's kind of a personal perspective. We've loved living here, and it's exceeded our expectations. So to kind of get down to the data, Multifamily Housing News recently rated Greenville the #1 emerging market in the US, and they have a variety of metrics and data that they look at to determine that. And I would note in Greenville, average price per unit is $144,932. We're buying these assets at $126,500 a door. And one thing that Andrew didn't cover, but let me mention, these assets are located in what I would consider to be a B location. Median household income is $75,000. So it's a solid middle income neighborhood, located between downtown and BMW and Michelin, good access to 85. So the location of the assets, the demographics, the income, average house price within a 3-mile radius is over $400,000. So this is a solid kind of middle income area, and the tenants, the residents in this area can certainly afford to pay higher rents. Maybe we can go to the next slide, Andrew. So, just some data. 15% rent growth in the last year. And I can tell you, Brian and I, with the help of Andrew, acquired an asset in May of 2021. So about 14 months ago, Carolina Commons. We rebranded it as the Cottages at Staunton Bridge. And doing a little quick math, in 14 months, we've increased the rent roll 28%. So not 15%, 28%. And we've actually done that in a way that's considerate of our existing tenants. And we were still able to increase the rent roll 28%. So you can kind of look at the data here. I don't need to go through it with you. Again, it shows the household income, average rent increase of about 15%. So Brian and I are in the market. We just rented a 2-bedroom unit on East North, about a mile from this property. It was rented at $950. We did just a basic unit turn, maybe $3,000-4,000 expense. We just rented it at $1,375, which was actually about our 4-year rent projection. And so Greenville's booming. We see it firsthand. And here's some data that kind of supports that. So maybe we can go to the next slide. Some raves about Greenville. Best place to live in South Carolina, where the jobs will be, best small city to travel to, best performing cities by Milken. So there's a lot going on. And I can tell you, when Laura and I visited in the spring of 2014, we could kind of see and feel the vitality and the energy and the growth and kind of the positive attitude to Greenville. We packed up our lives in Silicon Valley maybe 6 months later, moved here in November 2014. And I can tell you the growth has not lessened. It's actually probably accelerated over the 8 years we've been here. Greenville recently opened a 60-acre park, Unity Park, right in downtown. The county government center is undergoing a $1 billion renovation right now. There's other $1 million, $1 billion renovations in Greenville. So there's a lot of investment going on. And we expect the growth of Greenville to kind of continue for many, many years. The same factors that attracted Laura and I to Greenville will continue to attract others. And then let's see what the next slide is.
Yep.
Yeah, so this is a great slide talking about the employment. So you've got BMW and Michelin, and these are high-tech manufacturing facilities. Every X car, every all-wheel drive vehicle BMW makes in the world is built in Greenville, Spartanburg. It's kind of hard to believe, but it's a true fact. We also have GE, Lockheed Martin, and Honeywell. There's great health care in Greenville. And actually, within about 1.5 miles of this property, there's the Patewood Medical Center, which is probably 10 to 15 medical buildings, 4 or 5 stories, employing thousands of people, both for the Prisma Health System and Bone Secures. Education's anchored by Clemson and also Furman University. And as I've mentioned before, Greenville's presence on I-85 leads to a lot of logistics and transportation jobs. The other thing I would say is about 10% of the population in Greenville is European due to the heavy presence of BMW and Michelin. So it's kind of a great mix. And it's happening. So I don't know what more to say.
You nailed it.
Brian may have some comments on the market. Brian is more in the day-to-day dealing with the rentals, and perhaps he can kind of jump in and talk about what it's actually like. How many vacant units do you have now, and what kind of the demand for rentals is?
Yeah, sure. So kind of summarize the demand of the market. So I can give you a great example. If when this webinar is done, you go to our website, propgreenville.com, you're going to find one listing, and we manage 420 doors. Wow. That's the only vacancy we have right now. And we have an application pending on it. So it's literally unbelievable. I mean, again, we've been in business 13 years now. Like Arn mentioned earlier, if anything, the growth of Greenville has ramped up in the past 5. It was growing when I moved here. It's been growing the whole time, but I'd say the last 5 years or so, roughly. I mean, it just seems to have snowballed and is growing like exponentially. COVID certainly was a big factor in that. I'd say roughly 60% of our tenants every year are moving here from different states, which I love to see, obviously, as an investor, right? Our population is just going to continue to grow. So yeah, the rental demand is just unbelievable. I mean, frankly, we don't have enough supply. So that's why I'm a big believer in the Greenville market and investing in multifamily. So we just simply don't have enough demand.
Thanks, guys.
I'm sorry, supply. Yeah.
That's all good. So, Arne, the only thing I'd add to this one is you look at, when you invest in a market, there's a lot of markets that have a lot of employment or jobs, but the one unique piece, or one of the unique pieces around Greenville, is the diversity. If you look at, it's not one or two or three industries. You don't want to rely ever on, hey, having a military base with 14,000 jobs and then that moves. You've got diversity here in spades too. So I'd add that to everything else you said, which you nailed.
Yeah, 100%. You got manufacturing, healthcare, logistics. There's actually kind of a startup venture capital scene here. It's not so much in tech, but it's in terms of business. And then the logistics and transportation is big.
Yeah.
The one thing not mentioned in this slide is Greenville Spartanburg has what's called the inland port, which is connected to the port of Charleston about 225 miles away by rail. And product comes in to the Greenville area, and then BMW and Michelin ship it out to the world through the port of Charleston. So the inland port is another major employer.
No, great point. Great point. All right, I know we're tracking a little bit over time, so appreciate that, Arne. I think there's one more in here I think you covered, but we just covered the demographics. So thanks so much for the market recap, Arne. So we're about wrapping up here. We covered the asset. In summary here, we got a great team. We talked about that, their track record. We talked about the location, the A school districts, the jobs in the area, the demographics. We talked about the financing, the debt terms, and again, in terms of volatile markets and crazy interest rates going up and down and sideways and all that, secured fixed rate debt. So no worries there. The properties are well maintained. We've completed due diligence. We're wrapping up the last pieces of that and the financial side now, but it's well maintained. They invested over $1 million in deferred maintenance recently. So, and it's got a very solid upside potential. We can't say that enough. We've been conservative with the projections. There's a lot of rent growth potential there. And again, we talked about $150 to $300 market rents. So again, a lot of upside potential even beyond what we've underwritten here. But so in summary, we love the deal. We'd love to have you invest alongside with this. We do think this will go fairly quickly. Typically, even with the size of a deal, will fill up in a week or two. So if you have any interest at all, please, I'll show you guys the form real quick. You've got a link through the webinar to confirm your reservation in there. We'll get this webinar recording out to everybody. But without further ado, I'll jump into some quick FAQs, some submitted questions. We'll run through anything on the line. I know we're a bit over projected time, but hopefully you guys are cool to hang on. A couple of FAQs, and we'll talk about next steps. Again, we covered this before, but a lot of the questions we get, will the sponsorship team be investing your own money in a deal? And the answer is a resounding yes. We love the deal. We're investing over $1 million of our own funds. Next question is, when can I expect distributions to start? And that answer will vary slightly depending on the class of investments, but we're projecting for the B and C classes where the chunk of the equity we expect to come in be about 6 months after closing. That could be conservative, but again, we can't control every variable. We want to make sure that we can meet our commitments. And Class A with the higher pref and with the limited upside, they'll start immediately after close. Another question we get a lot is, what about inflation? Are you worried about that? The impact on renovation costs? A couple of notes there. Again, one, we've secured a buffer, additional working capital there, and that's factored in. And in fact, in a multifamily property, inflation works quite a bit in your favor as rents are tied closely to inflation as well. So that works just as much in our favor, if not more, than a renovation costs. The other note I'll call out there that I didn't mention before is that Reed has proven his ability to secure large quantities of shipments and materials direct from China and containers. So material costs, he gets massive economies of scale. And I remember listening to his presentation at a summit in February, actually, where it was 20, 30, 40%, 50% higher or lower than your big box store. So again, with renovating 200 plus units and having that connection to offshore, it really works in our favor in terms of the renovations. How can I be sure to secure my reservation? Of course, click the link, get it in there as soon as you can. Again, if you've got any questions at all, we do expect this to move quickly, so please give us a shout. And then shortly thereafter, we'll talk about how to get into the portal and move things through the private placement memorandum. I'll cover that in a second. Last question we get all the time is, can I use self-directed IRA? And the answer is yes. We want to make sure that one can typically, my experience has shown, can take a little bit longer of a lead time. And we'll talk about funding deadlines here in a second, but I would highly recommend, if you're planning on using retirement money of any sorts, we also take cash accounts, that let us know right away so we can start that process rolling, especially if you don't already have a account with that designation established. It can sometimes take up to a month. So give us a heads up. We're happy to walk through with that and make some recommendations as to how to get rolling. A couple of other pre-submitted ones, and we'll jump to the chat window here in a second. How far apart are the properties from each other? I think that one's been covered, but they're right across the street basically from each other. So again, really easy to share resources. Who will be managing the deal on the asset? We covered that. It'd be Josh from Reed's team with a lot of oversight from Reed. And then we've got, of course, Brian and Arn on the ground working with local vendors and overseeing construction and unit turns. Another question we got, what is the minimum investment? Again, for our Class B shares, the minimum is $50,000. Happy to talk through your individual situation. Give us a shout if you have any questions, concerns around the minimums and the different classes or what's right for you. I know I'm going quickly, but I'm just trying to be conscious of time, guys. Next question we got are, can the properties be sold independently or individually? The answer, that's a good question. The answer is yes. We're actually securing Bonito and Collaborate in 2 different LLCs, so we can evaluate different options to exit or refinance appropriately. So great question there. Last one I got was pre-submitted was, will there be another webinar? The answer is not through Redline, but this will be recorded and we'll be distributing it to our entire investor base. But if you've got other colleagues or friends or professional acquaintances that would love to learn more about this, I'd be really grateful to connect myself with them. And we really love the opportunity to share this webinar and recording with them as well. So I will pause there. Brian or Arn, anything else through the chat we didn't already cover that you haven't already addressed?
No, I don't think so. Go ahead, Brian.
No, I was gonna say, I don't think so on my end, Andrew, unless there's any questions we can help with.
Cool. All right. So last piece of the puzzle here are, what does the timeline look like? So we mentioned earlier, the team is just walked through the due diligence. So we're just verifying, crossing our T's, dotting our I's. That's been completed physically. We've got some other work going on. I'll be down with Brian and Arn on site tomorrow, which leads me to my next piece is, if you'd love to walk the asset yourself, or you'd like to take selfies with Brian or Arn and I, and maybe you get our autographs, just kidding. We'll be on town. We'll be in town. I'll be leaving in a matter of about 12 hours here, getting on a plane. So really looking forward to spending time with these guys and walking these properties, and going to try to bring my drone along if the FAA doesn't take it on the plane with me. So next piece after that. So again, get your reservations in. The next step for that will be to get set up in our portal, if you're not already, through InvestNext. And if you're not part of if you're part of Carolina Commons, you're already in there. We'll just verify everything's still current. But we'll send out a link for that. We'll get you set up, hold your hand through that process. It can be sometimes tricky with just getting all the accounts in there and everything, but we're here to help. So that should be available the week of August 1st. We'll be looking to sign all documents. I forgot to put this in there, I think by the 14th or 15th of August. Arn, keep me honest there. I forgot to put that one in, but.
That's about right. You know,
Yeah.
Sometimes these documents come late, but that's the target.
Yes, thank you. And then the most important piece of all, of course, to get us to close, we need the funding. We've got a $16 million total raise. And the latest for that, absolutely would love to see that a little bit before, will be August 31st. So again, I'll emphasize, if you're using a self-directed IRA, that's where a lot of our investors can sometimes get hung up or gets delayed, just not by their fault at any means, but the custodians can take some time. So if you're doing cash, that can usually move pretty quickly with a wire. But if you're doing self-directed IRAs or anything like that, just let us know. We'll work through the process with you. And then finally, and most exciting, is the closing. And we're looking at about the mid-September timeframe, subject to change. A lot of moving pieces and variables there with, stuff on the seller side and the lender. So we'll see how that goes, but we're targeting about a month and a half away. Aaron or Brian, anything else I missed as we close out?
I think we got
Nope.
everything covered pretty well.
Yep. We're very bullish on Greenville, excited to work with you again, and happy to answer any questions you or your investors have moving forward. So just happy to help.
Awesome. Well, again, reach out with any questions. You guys have my email address, and my cell is at the end of this deck. We'll send you guys a link to the recording and to the presentation itself. But thanks so much for joining and hanging out with us. We'll talk soon and looking forward to partner with you guys.
Yep. Thanks so much.
Take care.
Yep. Bye-bye.